Assalamualaikum and a very good morning. So today we're going to go into a new MFRS which is related to investment property. This is MFRS 140, another MFRS that is often being used by companies as they may have this kind of asset in their company. So to begin with, I'm going to explain what we are going to learn for today. So we're going to cover the terms that we need to know before when we do MFRS 140, and then after that we're going to go to the initial the recognition of the MFRS 140. This is followed by the initial measurement and subsequently the subsequent measurement, and how do we account for transaction that related to transferring from one classification such as MFRS 140 to another classification such as MFRS 116. Okay, so to begin with, we are going to go to the definition of MFRS 140. So investment property relates to property which includes land or building or part of building held to earn rentals for capital appreciation or both. Alright, so if let's say a company owns a property, so if the intention is to be used in the business, then that property will likely falls under MFRS 116. However, if our intention to purchase, when we purchase the asset or property, and the intention is to rent it to others or for capital appreciation, that is, we have the intention to sell it back, then this type of property will fall under MFRS 140. Investment property includes land that held for long-term capital appreciation. So if we hold a land with the intention to sell it back for over a period of years, then this land will be included as investment property. Right. Then another property that is included under MFRS 140 is that land that is held for indeterminate future use. Right. So in this case, this will fall under MFRS 140. Building that is leased out under an operating lease, right, where lessor own and record the building in its books, but then rent out the property to lessee, which this will fall under operating lease agreement, so should also be included as part of the investment property, because this property, the lessor actually rent out the property for the lessee, right? And then property that is constructed for future use as investment property. So if let's say if we construct a building, all right, and the intention is for us to sell it back later on, so this one will also falls under investment property. Okay. However, under MFRS 140, we exclude certain types of property. First is when property that meets the definition of PPE. Right. So under this classification is when we purchase a property with either intention to be used in the business to generate income. So in this case, we will classify this property under MFRS 116. Another type of property that should be excluded from MFRS 140, right, is where the property is held for sale in the ordinary course of business. All right. For example, if we purchase a property, and we purchase property because it is the nature of our business is selling and purchasing and selling property, then this property should be treated as inventory and classified as MFRS 102. Okay. Now, the third type of property that should be excluded from MFRS 140 is when we construct for third party. So this is different from the earlier property where we construct for future use as investment property. So property constructed for third party means that when someone asks us to build a building for them, right? So when we construct a building on behalf of another person, then this will become a construction transaction. So this will falls under MFRS 111. So we should not record this under MFRS 140. Okay. Now, another property that should be excluded from MFRS 140 is when we have property that is leased to another entity under a finance lease. Right? Now, this is different from the one that we had earlier, where the building leased out under an operating lease. Alright? So, in this case, this property should be treated under MFRS 117. Okay? So, what is the difference between finance lease and operating lease? Right? So, under MFRS 117, they have provide the definition and distinguish the difference between finance lease and operating lease. Okay? So, a finance lease is when a lease that transfer the substantial risks and rewards incidental to ownership of or asset. For example, let's say that if we have a property, now we have a finance lease to another person. We call it as the lessee. So, when we agreed to a finance lease, meaning that we have transferred the risks and rewards to the other person. So, all the recording of the transaction will be recorded under will be the responsibility of the lessee. Okay, so that is the lessor would daily recognize the asset, and the lessee will recognize that lease asset. All right. So if let's say the substantial risks and rewards still falls under the lessor, then this property or this lease will become an operating lease. So if you look at the definition of operating lease is a lease other than the finance lease, meaning that the asset do not transfer to lessee but maintain in lessor's book. So you can see the difference between finance lease and operating lease. Okay, now let's look at the example. For example, one where a building is an investment property. Okay, so if you look at the example, an entity owns a building that it rents out to independent third parties under operating lease in return for rental payments. So, when we look at the definition of an operating lease, that is a lease other than the finance lease. So, what is a finance lease? A lease that transfers the substantial risks and rewards incidental to ownership of asset. Right? So, since the statement here says that, the example here says that an entity owns a building that it rents out to independent third parties under operating lease in return for rental payment, then we can say that the building is classified as an item of investment property by the entity, right? Because it is a property held to earn rentals, right? So when we come back to our notes, okay, property that is leased out under an operating lease, where the lessor own and record the building in its book, but rent out to lessee under operating lease agreement. So this will fall under investment property, MFRS 140, right? Okay. Now let's look at example number 2. An entity owns a building that it rents out to an independent third party under a finance lease in return for rental payments. So recall that when a finance lease is when we de-recognize the asset and lessee recognizes that lease asset, meaning that we have transferred the substantial risks and rewards to the ownership of an asset. So in simple words, we do not have that property with us anymore. So if you look at the requirement where they ask us to determine the classification of this building under finance lease, then the building is not classified as an investment property by the entity. The entity has a receivable in respect of the finance lease. The entity has to re-recognize the property at the commencement of the lease term. Okay, so you can see the difference between finance lease and operating lease, and you can say that those operating lease, which is used for rental income, to obtain rental income, will be classified as operating lease and subsequently is an investment property. But for those property which falls under finance lease, we don't recognize that as an investment property. Now let's say that if we own a building with many floors, okay? So in that case, and we have a building of many floors, and then we occupy certain floor of the building, live and rent out the rest of the building. So how do we recognize that building, whether is it investment property or considered as property, plant and equipment under MFRS 116? This is where we have partial own use, right? That is, if owner use part of the property for own use and part to earn rental or capital appreciation, and the portion could be sold separately, right? Meaning that, for example, if we have 5-floor building, we actually occupy the first floor and we either rent or sold part of the building, and the portion could be sold separately, then the entity should account for the portion separately unless the portion is insignificant. Therefore, that is, if the owner occupied portion is insignificant, then the whole building should be classified under investment property. So coming back to the example that I used just now, if we have a building of 5 floors and we occupied the first floor, whereas the second, third, fourth and fifth floor, we rent it out, or we rent it out to other people, or we sold it to another people, then we can say that that particular or the owner occupied portion, the owner occupied building is, the whole building is investment property, right? So we look at example number 3. Now in this example, on 10 January 2010, Puncak Alam Plantation Berhad purchased 2,000 hectares of agriculture land at a cost of 42 million. Incidental costs associated with the land acquisition amounted to 420,000. The company decided to use 80% of the land for oil palm plantation in stages, and the remaining land will be kept either for capital appreciation or rental to other plantation company. The agriculture land acquired a freehold title. Discuss how the company should classify the agriculture land. Now, meaning that this land is partly occupied by the owner and partly is held for rental or for capital appreciation, right? So, if now in this case, 80% of the land should be treated under PPE under 116, and the remaining 20% should be treated as an investment property under MFRS 140. However, if the land is occupied by the owner is 20% and the remaining land, 80%, is held for rental or for capital appreciation, then the whole cost of the land the whole land should be treated as investment property under MFRS 140. Alright, because if you look at the definition of partly used, they say that the entity that could be sold separately will be account for the portion separately unless the portion is insignificant. Alright, so if the owner actually stays in the use the partly of the land of the property, but the amount is insignificant, then we can say that the whole building is investment property. Alright, so in this example, because the land is 80% of the land is occupied by the owner, whereas only 20% is for rental or capital appreciation, then we can say that 80% should be accounted under MFRS 116, whereas 20% will be accounted as investment property. Okay. However, if it's the other way around, right, where 20% is occupied by the owner and 80% of the land is for rental or capital appreciation, and because 20% is considered insignificant, then the whole cost of the building is considered as investment property. Okay. Now, in terms of provision of ancillary services to occupants, right? Now, this one depends whether the amount spent on the ancillary services is significant or not significant. If the services such as security or maintenance services are insignificant, then we will consider that property is investment property. Okay. However, where the services is significant, such as hotel, because of the customers coming in and out, checking in and out of the hotel, so the services of cleaning the hotel rooms is considered significant, then the property should be classified under PPE. Okay, so we look at example number 4. An entity that owns a building rents out to independent parties under operating lease in return for rental payment. Okay. The entity provides cleaning, security and maintenance services for the lessee of the building. Alright, so explain the classification of the building. Okay. If the services provided by the entity are insignificant to the arrangement as a whole, then the property is considered as investment property. Alright, so the ancillary services, if the amount spent on that property is insignificant, then we will classify that property as investment property. In most cases, cleaning, security and maintenance services will be insignificant, and hence the building would be classified as investment property. If let's say that the ancillary services provided are significant, then the property should be classified under PPE. Right? For example, if an entity owns and manages a hotel, the services provided to guests are significant to the arrangement as a whole. Okay. Now we look at another example where the ancillary services to components is significant. An entity owns a building which it operates, that is, it rents out the hotel rooms to independent parties under an operating lease in return for rental payment. Now, the entity provides hotel guests with a range of services commonly provided by boutique hotels. Some of the services are included in the room daily rate, for example, breakfast and television. Other services are charged for separately. For example, the meals, room bar, gymnasium facilities, and guided tours of the surrounding area. So, discuss the classification of building. So, in this case, because the building is used to operate a hotel, right? So, they will incur ancillary expenses in terms of providing services to hotel guests, and then cleaning the gymnasium facilities, for example, for hotel guests. So in this case, this building is not classified as an investment property, as it is actively engaged in operating a hotel business in the building. So we should classify this building as property, plant and equipment. Okay. Basically, because when we look at the cash inflow, we will obtain rental income and income from other services provided, where the nature of the services provided, or the nature of the business is hotel industry, and therefore these ancillary expenses will cost, or the auxiliary expenses is, even though it is significant, it should not lead to the building being treated as an investment property. So it is considered as a day-to-day activity. So we will actually classify this particular building in example 5 as a PPE that falls under MFRS 116. Right, let's look at the intercompany rentals. Intercompany rentals is a situation where there is a parent-subsidiary relationship, right? And what we need to do is, when there is an intercompany rentals, for example, parents rent its property to its subsidiary, then this shows that in the parent's financial statement would have an item known as rental income from subsidiary, and in the subsidiary financial statement there is an expense known as rental expense to parent. Now in this case, we have to eliminate the intercompany rental because as a group they are considered as one entity. So when we record in the financial statement of the group, that property will be classified as property, plant and equipment, falls under MFRS 116. However, in the parent's financial statements, that particular property will be classified as investment property, falls under MFRS 140. Why? Because the parent has a building that is rented out, and the intention is to rent out, and that is rented out to the subsidiary, and that's why that particular building is known as investment property. Okay. Now, after exposing to the definition and introduction of MFRS 140, now we need to know how to recognize investment property. Similar to other MFRS, recognition of MFRS 140 is we can recognize an investment property if it meets these two conditions. That is, there is a probable future economic benefit that will flow into the entity, and the cost can be measured reliably. Okay. Now we go to initial measurement, that is when we first acquire the investment property. How do we recognize the investment property? Alright, so similar to MFRS 116, property, plant and equipment, we should recognize the investment property at cost. That is the cost that we have spent to acquire the investment property. And this include transaction costs such as legal fees, right? Consultation fees. So all of these costs, these transaction costs, will be included in the cost of the investment property when we record in the books of accounts. All right. However, asset that falls under operating and finance lease should be measured initially at the lower of fair value or present value of minimum lease payment. The reason being because when we have operating lease and finance lease, not the lessee will not make the payment as a whole. In other words, they don't make the full payment, but they make the payment on installment basis. So what we need to do is we have to bring it to the present value of the minimum lease payment. Okay. If let's say we acquire the investment property through exchange, right? Meaning that we acquire investment property by giving up another type of asset. Okay, so how do we measure the investment property? First, we have to rely on the fair value of the asset acquired. For example, if we want to acquire an investment property and the value of the investment property, the carrying value of the investment property is 1 million, and in order to have that, to acquire the investment property, we exchange it with another type of asset, for example, 5 units of cars, which amounting to 1.2 million ringgit. So in this case, when we acquire the investment property, we will recognize the value at 1.2 million ringgit. That is the value of the 5 vehicles that we have given up. Okay. If, let's say, we do not have the fair value of the asset acquired, then what we need to do is we have to rely on the fair value of the asset given up. Alright. So, repeat balik ya. Now, the fair value of the asset, okay, if let's say investment property is acquired through exchange, then meaning that we acquire investment property and in return we give up 5 units of motor vehicles, alright, then what we need to do is we have to rely on the fair value of the asset that acquired. For example, if we have an investment property valued at 1 million, and in return for getting the investment property, we dispose 5 units of cars valued at 1.2 million, then when we want to record the investment property in our books of accounts, we need to take the value of the IP, that is the investment property, which is 1 million. Let's say that if you cannot determine the value of the investment property, then we have to rely on the fair value of asset given up, which is 1.2 million. Now, let's say that if you cannot determine the fair value of the asset given up, that is the 5 units of motor vehicle, we have to rely on the carrying value of the motor vehicle given up. Let's say, for example, if the carrying value of the asset motor vehicle given up is 800,000, then we have to rely on the 800,000 if we could not rely on the first two requirement. Now let's look at one example. On 1st January 2000X1, an entity purchased an office block for 1 million. The purchase price was funded by a loan. The loan is secured against the building. Non-refundable property transfer taxes and direct legal costs of respectively 50,000 and 10,000 were incurred in acquiring the building. In 2000X1, the entity redeveloped the building into an upmarket residential apartment for rent under operating lease to independent third parties. Expenditures on redevelopment were 100,000 planning permission and 1.5 million construction costs, including 60,000 refundable purchase tax. The redevelopment was completed and the apartments are ready for rental on 1st October 2000X1. Starting from 1st January 2000X2, the local government charged the entity property service tax of 1,000 per month on the building. The entity has incurred 120,000 maintenance costs during the year ended 2002. So what is the cost of the building at initial recognition? So the cost of building at initial recognition is 1,000, that is what, 1 million. And then we have transfer tax of 50 million. And then direct legal cost of 10,000. And we have planning permission on the redevelopment cost 100,000 and 1.5 million. And then we have refundable tax 60. So the total cost of the investment building is 2.6 million. Okay. Now we go to the next part of this MFRS, that is subsequent measurement of investment property. So since the initial investment is recorded at cost, once we have reached to the second year of owning that investment property, we have to decide whether we need to rely on cost model or rely on fair value model. Okay. Now, what is the difference between cost model and fair value model? Okay. Now, if it's cost model, then this investment property will be measured in accordance with requirements set out in MFRS 116 for cost model. That is, to determine the carrying value of investment property, we have historical cost minus accumulated depreciation minus accumulated impairment loss. So the treatment is the same as the one used in property, plant and equipment, MFRS 116. If we decided to use the fair value model, so what we need to do is we have to value the investment property based on the market value, right, at measurement date. And the difference between the fair value, the current fair value, and the previous fair value will be recognized as a gain or loss in the income statement. There will be no asset revaluation reserve, and there should not be any depreciation as well. Okay, we look at example number 7. On 1st January 2007, Perdana Petro Berhad purchased a piece of land but still undecided on its future use for 9 million. Alright, so the fair value of the land given by the independent valuation on 31st December 2008 was 10.5 million. It is the policy to adopt the revaluation model and fair value model for its property, plant and equipment and investment property respectively, subsequent to its measurement and recognition. Alright, meaning that after the initial measurement, so subsequent measurement, they have decided to value their PPE under revaluation model and to revalue the investment property under the fair value model. Okay. So explain briefly the appropriate classification of the land and its initial measurement. Now, the land should be treated as investment property due to the management is undecided what to use of the land. All right. So we will recognize the we will recognize the land at an initial measurement of 9 million. All right. So how do we account for that? That will be debit investment property and credit bank or payables. Okay. Subsequently, the land would be measured at fair value, that is 10.5 million, as the company adopt the fair value model to account for its investment property. Right? So the difference between the fair value of 1.5 million and the carrying value of 9 million will be recognized in the income statement. Alright, so what do we need to do? We have to debit investment property and credit fair value gain on investment property 1.5 million. So in the land account, we will record, in the land of investment property account, we will record the value at 10.5 million. Next we go to what happens if we transfer the investment property to another type of classification, such as PPE? Okay, so we know that sometimes transfer to or from property shall be made when there is a change in use. So transfer from IP to PPE effective when the owner starts occupy the building. So if we decided to change from IP to PPE, then the property deemed cost shall be at its fair value at the date of change, and the difference between the carrying value and the fair value will be recognized in statement of profit and loss. Alright? Okay, so if we decided to change from IP to PPE, at the date of change, we have to compare the fair value, the fair value at the date of change will become the fair value of the PPE at the date of change. So let's say, for example, if the fair value of the investment property is 1 million, and we decided to change from IP to PPE, then the fair value at the date of change will become the value of the property classified under PPE. Now we can also change the property classification from MFRS 140 to property to inventory that falls under 102. In this case, the property deemed cost shall be at its fair value at the date of change, and the difference between carrying value and the fair value will be recognized in the statement of profit and loss. So you find that if your investment property change status from IP to become either PPE or inventory, the treatment would be the same. Now, if there is a change from PPE to IP, okay, if it's the other way around, then if the PPE becomes IP that will be carried at fair value, then the measurement at the date of change shall apply revaluation model in accordance to MFRS 116. Right? For example, if let's say your PPE is valued based on revaluation model, and it becomes IP, which will be carried at fair value. So at the date of change, we have to use the revaluation model based on the MFRS 116. Okay. If let's say we decided to change from inventory to IP, okay, that is the classification change from MFRS 102 to MFRS 140. If the inventories becomes IP that will be carried using fair value, then the initial measurement at the date of change will be the fair value as well. So any difference between the carrying value and the fair value will be recognized in statement of profit and loss. If let's say, for example, the property is under construction, which we are going to change the status to investment property, the treatment would be when the entity completes the construction of self-constructed investment property that will be carried out at fair value, then any difference between the fair value at the date of change and the carrying value shall be recognized in the statement of profit and loss. Okay, so this is how you're going to treat your investment property if it changed the status from one MFRS to another MFRS. Now, when we dispose our investment property, what we need to do is we have to de-recognize our investment property. Right? So we need to eliminate from the statement of financial position where the IP was placed. Now we have to take it out once we have decided to dispose. That is, we de-recognize the investment property from our books of accounts. Okay. Now let's try So let's go back to the change of status from transfer. When it relates to transfer, let's look at the example number 8. On 1st January 2001, an entity acquired an investment property for 1 million, and then at 31st December 2000X2, the entity measured the fair value of the property at 1.2 million in its statement of financial position. By 31st December 2003, management decided to occupy the building as the company's business expanded rapidly in recent years. So meaning that at first they acquired the investment property, then at 31st December 2003, they decided to occupy the building. So there is an indication of a change of status from IP to PPE. On 31st December 2003, the management estimates the recoverable amount of the building as 700,000 and its remaining useful life as 30 years. The residual value of the building is presumed to be nil. Okay. Now the management adopt fair value model and cost model to account its investment property and property, plant and equipment respectively. Management also believes that the straight line method reflects the pattern in which it expects to consume the building's future economic benefits. The value of the land on which the building is situated is immaterial. Right? So they ask us to explain the accounting treatment for the property in the year ended 31st December 2001, 2002, 2003 and 2004. And also to prepare the journal entries when necessary to explain your answers. So when we first purchased the investment property, we will debit investment property 1 million and credit bank 1 million when we recognize the building as an investment property at the initial recognition. Right? So we will recognize at initial recognition at cost. And then in 2002, subsequent measurement, they decided to use the fair value model. Okay. So in 2002, the fair value change of 200,000 is to be recognized in the statement of profit and loss. That is, we compare the carrying value at the first value, the value of the investment property at first year, 1 million, and the fair value of the property, which is 1.2 million. So the difference between 1 million and 1.2 million, which is 200,000, will be recognized in the statement of profit and loss, recognized as a fair value gain on investment property, 200,000. Right? So the double entry would be debit investment property, credit fair value gain on investment property, 200,000. At 31st December 2003, the entity must transfer the property from investment property to property, plant and equipment. And this property, plant and equipment will be recognized at its carrying amount of 1.2 million. That amount is deemed to be the cost of the property. Okay, so we debit property, plant and equipment 1.2 million, and then credit investment property 1.2 million. Now when we look back at the question, they say that on 31st December 2003 that there is a recoverable amount of the building as 700,000 and the remaining useful life is 30 years. So at 31st December 2012, because we have reclassified the investment property to property, plant and equipment, and we find that the value has reduced to 700,000, that is the recoverable amount. When we compare, resulted to a impairment loss of 500,000. Okay, so the impairment loss of 500,000 should be recognized in the profit and loss account for the year ended 31st December 2003. So we debit impairment loss 500,000 and credit accumulated impairment loss 500,000. Okay. Since we are using the we have reclassified the investment property to property, plant and equipment, so we are going to depreciate the building on a straight line method over a useful life of 30 years. So what we'll do is calculate the amount of depreciation to be charged, that is 1.2 million minus 500,000, that you have 700,000 divided by 30. So your depreciation charge for the year is 23,333. So your debit debit depreciation expenses, credit accumulated depreciation. So the carrying value of the asset of the property at 31st December 2014 is 676 and 677 ringgit. Next, we look at example 9 when it relates from a change from PPE to IP. On 1st January 2000 X2, an entity vacated a building that it owns and had occupied for many years. On 1st January 2002, the building had a carrying amount of 600,000, which is derived from the cost of 1 million less 400,000 accumulated depreciation. On 1st January X2, the building had a fair value of 1.5 million. Upon vacating the building, the entity entered as lessor into a 7 operating lease agreement over the building with an independent third party. The entity measures property, plant and equipment using cost model and investment property using fair value model. So explain the accounting treatment of the above transfer. Prepare related journal entries to explain your answer. Okay. So when they transfer the property out of the property, plant and equipment on 1st January 2000 X2, the value of the building, that is the carrying amount of the building, is 600,000. And into the investment property at its fair value, which is 1.5 million. So the difference of 900,000 will be recorded as a surplus in asset revaluation in other comprehensive income for the year ended 31st December 2000 X2. So we debit investment property 600,000. We debit accumulated depreciation 400,000 and re-recognize the property, plant and equipment 1 million. Right? So in your investment property, and then you will debit your investment property 900,000 and credit your asset revaluation reserve 900,000. Okay? So this is the treatment that you need to do when you change from PPE, that is from property, plant and equipment, to investment property. Okay? So let's test your knowledge on multiple choice question. Investment property is defined as, if you can recall back what we have learned earlier, property which is land or building or part of building that is held to earn rentals or for capital appreciation or both. So if you look at the question here, there is a definition of such, that is the property, land or building or part of the building or both which is held to earn rentals or for capital appreciation or for both. Now we look at question number 2. An entity operates a bed and breakfast from a building it owns. The entity also provides its guests with other services including housekeeping, satellite television and broadband internet access. The daily room rental is inclusive of all these services. Furthermore, upon request, the entity conducts tours of the surrounding area for its guests. Tour services are charged for separately. Then this entity should be recognized as in property, plant and equipment. So the answer is C, that is the arrangement between the entity and the bed and breakfast guest is for provision of services rather than the property being a passive investment. Now question number 3. An entity must measure its property after initial recognition. So after the initial recognition, so they can either use the cost model or the fair value model. So the answer is is A, that is either at fair value or using the cost model. That is, although we should take note that if let's say you have decided to choose fair value model, then it should have the same accounting policy for all investment property. The same goes that if you decided to use the cost model at the second measurement, subsequent measurement, then you have to use the same accounting policy for all investment property. However, let's say for example, due to certain circumstances, you have to change your accounting policy from fair value model to cost model or the other way around. You can do that if provided that you explain the justification on why the change of the accounting policy from one model to another model and states that in the notes to the accounts. Next question. On 1st January 2000 X1, an entity acquired a building for 95,000, including 5,000 non-refundable purchase tax. The purchase agreement provided for payment to be made in full on 31st December 2001. Okay, that is deferred payment. Legal fees of 2,000 were incurred in acquiring the building and paid on 1st Jan 2001. Okay, the building is held to earn rentals and for capital appreciation. So we know that this is an investment property. An appropriate discount rate is 10% per year. Right? The entity shall measure the initial cost of the building at. Alright. So since this is an investment property, and we have to make the full payment in 1 year later, in one year time, so we have to calculate the present value of the purchase price. So the answer is A, that is 95,000 purchase price excluding the refundable tax divided by 1.1. Okay, so the discount, this 1.1 is derived from the discount rate. So you have a present value of 86,364, present value of the purchase price, plus 2,000 direct costs. So the total cost of this investment property is 88,364. Okay. Next question. Our last question would be, on 1st January 2000 X1, an entity acquired a tract of land for an undetermined purpose. And then on 1st January 2000 X4, the entity started constructing a building on the land for use at its administrative headquarters. And then on 1st January 2005, the entity's administrative staff moved into the building. 3 years later, that is on 1st January 2008, the entity's administrative staff moved into newly acquired premises. The old building was immediately rented to an independent third party under an operating lease. On 31st December 2009, the entity accepted an unsolicited offer from the tenant to purchase the building from the entity with immediate effect. The fair value of the property, that is the land and the related buildings, can be measured reliably without undue cost or effort on an ongoing basis. So, the entity shall recognize for the tract of building and related building as, the answer is B, investment property during 2001 and 2003, and 2008 and 2009 as and property, plant and equipment, and during 2004 and 2007. Right, so if you look at the tenure from 1st January to the period of 1st January 2001 and 2003, okay, this falls under the definition of PPE. Okay, and then subsequently in 2008 and 2009, okay, is also classified as investment property. And then during 2004 and 2007, the investment property, the property is classified under property, plant and equipment. Okay. So we have completed MFRS 140. So if you go through briefly on what we have done today, we have learned on what is the definition of property under MFRS 140. Okay. We have also learned on the recognition of a property, which is when there is a probable future economic benefit that flow into the entity, and the cost can be measured reliably. And we have also covered initial measurement, that is, how do we recognize the cost of the investment property when we first recognize or when we first acquired the investment property. And subsequently, we have also covered subsequent measurement, that is second year onwards of having that property. How do we recognize the value of the investment property? So we were given two choices, that is, companies can either choose the cost model or the fair value model. And then we proceeded to cover transferring from one particular from either investment property or to another type of MFRS, either from investment property to PPE, that is falls under MFRS 116, or we transfer from IP to inventory, okay, that is from MFRS 140 to 102. And we have also covered change from PPE to IP and change from inventory to IP. And finally, we covered the change from construction, that is under MFRS 111 to IP. Alright, so that's all for today. We have basically covered MFRS 140 and also examples given to enhance your understanding on investment property. Assalamualaikum and thank you.